Excellency, distinguished guests, ladies and gentlemen, good morning and welcome to public lecture by Professor Robert Aliber this Thursday morning. My name is Tanyavi Chunchin and I will be your MC for today's event. Let me begin by briefing the schedule for today. To begin the event, our Vice Rector for International Affairs, Assistant Professor Dr. Nithinan Wisaweswan, will offer an opening speech, taking this opportunity to welcome our guests here today. And this will be followed by our lecture on currency turbulence and banking crisis, delivered by Professor Robert Aliber, Professor Emeritus of International Economics and Finance at the University of Chicago, United States of America. To begin this morning proceeding, it is with pleasure that we now welcome our Vice Rector, Assistant Professor Dr. Nithinan, to provide the opening speech.
Yes, thank you very much and good morning. Welcome Professor Aliber to Thammasat University. Welcome Madam Aliber as well to Thammasat University. Welcome Excellencies, distinguished guests, ladies and gentlemen, all students, professors of Thammasat, to the special lecture on currency turbulence and banking crisis. I wish to take this opportunity to acknowledge the presence of our special guests and also warm welcome to all of you to Thammasat University. Ladies and gentlemen, Professor Aliber writes and conducts a number of research on financial and monetary economics, and also related policies, particularly in international context. So his contribution on the theory of foreign direct investment is well noted and widely known at the international level. One of his recent remarkable works on financial crisis was that he predicted the Icelandic banking crisis actually 18 months before it actually happened. So today we are very privileged to have Professor Aliber, who is an expert on international finance, to share with us his experience and insights about the causes and mechanisms of the financial crisis, particularly on the related occurrence of banking crisis around the world. I believe that his expertise on the financial crisis and the international regulations, particularly on the banking system, will provide us a better understanding on what is happening in our financial world. So that can also help us understand what happened in our region almost 20 years ago as well. Before I conclude my welcome remarks, I would like to wish you all the best for this interesting lecture. I'm sure that Professor Aliber's lecture will give us plenty food for thoughts and insightful remarks. Hopefully that at the end of this session, you will have chance to pose questions, comments, and a number of ideas that you may share with Professor Aliber as well. At the end of the session, on behalf of Thammasat Institute for Study of International Cooperation and on behalf of Thammasat University, I'd like to express my sincere gratitude to Professor Robert Aliber for your time and resources in giving this lecture. I have appreciation once again to all of you who present here today, and particularly special thanks to the staff of the Thammasat Institute for Study of International Cooperation for making this event successful. Thank you to Dr. Supat as well for kindly organizing this event. Hopefully you will have inspiring and enlightening lecture. Thank you very much.
Thank you very much, Dr. Nithinan. Before moving forward to the lecture, I would like to take this opportunity to briefly introduce Professor Robert Aliber, our distinguished guest speaker today. Professor Aliber received his doctoral degree from Yale University in 1962 and bachelor degrees from Williams College and Cambridge University. He joined the faculty of the Graduate School of Business at the University of Chicago in 1965 and retired in 2004 as Professor of International Economics and Finance. Prior to joining the Chicago faculty, Professor Aliber was Senior Economic Advisor, Agency for International Development, Department of State. Professor Aliber has taught many schools, including National Westminster, London Business School, Free University of Berlin. He was also a visiting professor at the Amos Tuck School of Business at Dartmouth College, just to name a few. In addition, he was the Hubert Norman Fellow at the Bank of England, the J.P. Morgan Prize Fellow at the American Academy in Berlin, and a visiting scholar at the Woodrow Wilson Center for International Scholars in Washington. Professor Aliber has been a visiting scholar at the Federal Reserve Bank of San Francisco, and also a consultant to the World Bank and the International Monetary Fund and various think tanks in Washington and London. Professor Aliber has written extensively about international financial issues, including changes in cross-border capital flows and changes in currency value, and the efficiency of the currency market. His publications include The New International Money Game, the 7th edition published in 2010. The Multinational Paradigm was published in 1995. He brought about the 6th edition of Manias, Panics and Crashes in 2010. In the early 1980s, he wrote a book on personal finance, Your Money and Your Life, and a much more comprehensive book on personal finance with the same title, published by Stanford University Press in November 2010. He is the co-editor of the collection of papers and reports that were published prior to the Iceland financial crisis. He founded Dorchester Capital Management in 1991, which provides asset management and financial planning service. Now, I would like to give the floor to Professor Robert Aliber, Professor Emeritus of International Economics and Finance, University of Chicago. The floor is yours, Professor.
Thank you. Thank you very much. I welcome this opportunity to return to your marvelous city, Bangkok. I was here in 1997, in March 1997. That was part of a trip to countries in this region, and the trip was prompted by a story in one of the local newspapers about a property price transaction in Hong Kong. The most expensive house on Victoria Peak had been sold by the owner of a Tokyo department store to the owner of a Hong Kong department store. I was just fascinated by that transaction. And so in the break between the winter and spring terms in Chicago, I decided to come to Hong Kong and nearby countries. I asked a former student in Hong Kong, please arrange a meeting with people involved in the real estate industry. And he did. That was my first meeting. And I had several questions for these people. The first was, what was the rental rate of return? And their answer was 3%. And the second question was, what is the mortgage interest rate? And their answer was 7%. And the third question was, how can you earn money, make money, if you earn 3 and pay 7? And they said, the price of real estate always rises. And I knew I was in a country, then still part of the UK, that was experiencing an asset price bubble. And on that same trip, I went to Kuala Lumpur, KL, and came to Bangkok. And I vividly remember flying into your airport twice. I won't go into why I flew into it twice. But on the approach to the airport was like flying over a Lego village. There was lots of structure, but there was no human activity. It was what would be called in China today a ghost city. And as I left Asia to return back to Chicago, I concluded there was a massive asset price bubble in this part of the world, in Southeast Asia. And 4 months later, in July of 1997, that asset price bubble began to burst. So my theme today, my topic is, why have we had so many banking crises in the last 30 years? Where do these banking crises come from? Now, I'm going to suggest that the features of these banking crises are very much the same. But I would guess that if I were to take a poll among people at the central bank in Thailand, and in Kuala Lumpur, and in Jakarta, and said, what was the cause of the banking crisis? They would say it has to do with the behavior of the lenders. And that clearly is the view within the United States. So if we were in Washington or in New York and said, what's the cause of the US banking crisis? The dominant answer would be, it's due to a group of bad actors. It's due to lenders who do not have an appropriate understanding of the risk of their loans. It's due to the failures of regulation. It's due to the corruption of the credit rating agencies. There would be 10 or 15 different explanations of what caused the crisis. And one of my sub-themes today is people who support this view are confusing the symptoms of the economic expansion in the several years prior to the crisis with the cause of the crisis. So that's one of the key ideas. We need to distinguish the symptoms of the crisis from the cause of the crisis. And let me put the challenge to what I would call the bad actor's point of view in the following way. If I'm granted one assumption, which I will identify later, that assumption is there's a surge of investment inflows into a country. If I take the increase in the foreign demand for US dollar securities between 2003 and 2006 as a given, then I'm prepared to argue that the United States would have had a massive banking crisis in 2007 and 2008, even if Mother Teresa had been chair of the Federal Reserve Board, and even if the Sisters of Mercy had been in charge of bank regulation. So the tension is between whether these banking crises that we see in different countries result from bad actors who live within those countries or result from an international monetary arrangement that is dysfunctional. And so my theme is that we have an international monetary arrangement that facilitates and leads to very large investment inflows into a country. And when a country experiences the increases in investment inflows, the price of securities, and including the price of real estate in a country, increase. But that increase in the investment inflows and in the price of real estate are too rapid to be sustained. And I will amplify a bit later what I mean by too rapid to be sustained. That at some stage, the lenders recognize that the indebtedness of the borrowers is increasing at too rapid a rate. And at that stage, the lenders become much more reluctant to buy the loans from the borrowers. And some of the borrowers no longer then have enough cash, enough money, to pay the interest to the lenders on their outstanding indebtedness. And at that stage, the prices of securities and the prices of real estate begins to decline. So I would say this description fits 30 or 40 countries since the early 1980s, that is in the last 30 years. So I use the word turbulence in markets. I take the term turbulence from the title of Chairman Greenspan's book, The Age of Turbulence. Greenspan does a comprehensive job of identifying the markets that have experienced turbulence. And by turbulence, we mean very large changes in the market prices of securities relative to their long-run average prices. The real estate markets experience a great deal of turbulence in every country, virtually every country. And stock prices increase as real estate prices increase, and then stock prices collapse. If we review the Japanese experience in the 1980s, stock prices and real estate prices increased by a factor of 6. And the stock prices and real estate prices peaked at the end of the 1980s, and then throughout the 1990s, stock prices and real estate prices declined, and by the year 2000, stock prices and real estate prices were about at the levels where they had been 20 years earlier. Now, one of the unique features of this period has been that many of the countries that have experienced banking crises have also experienced currency crises. They've experienced currency crises in the sense that the borrowers in these countries have not been able to adhere to the contracts to repay loans denominated in the foreign currency. Another feature of this period has been that these economies have had what I would call a boom and bust cycle. So the United States had a U.S. economy grew relatively rapidly between 2003 and 2007. And then property prices began to decline in 2007. The banking system began to collapse at the end of 2007, and then we had the massive crises involving the failure of Lehman in 2008, and then we had a very sharp decline in economic activity, the sharpest decline in economic activity in the previous 70 years. And many countries have had this sort of boom and bust cycle. One feature of this cycle has been that economic growth has been very slow after the economic collapse, after the collapse of many of the lenders, and governments, have relied on very expansive monetary policies. So where does this turbulence come from? A former Secretary of the Treasury of the United States, Tim Geithner, who actually actually may have been born in Bangkok, and his father was the foreign representative here. Geithner has written a memoir called Stress Tests. And one of my favorite authors, Michael Lewis, reviewed Geithner's memoir, and he said, Secretary of the Treasury Geithner believes the U.S. banking crisis was an act of God. That was a little tease in that statement of Michael Lewis. But what we need is a better understanding of what the causes of banking crises are, and why so many countries have had banking crises. And one of the traditional distinctions that economists make is between structural shocks. The classic example of a structural shock is a change, a sharp increase or sharp decrease in the price of oil, and monetary shocks. One interpretation of a monetary shock would be a change in the central bank interest rates or the rate of growth of the money supply. But when I use the term monetary shock, I mean a change in investor demand for foreign securities. And so what I'm going to try to do today is to answer the question, where do these banking crises come from? And the preview to that answer is, these banking crises are a result of structural shocks. Now this gets involved in a long-term debate in international finance about the nature of the currency system. So my friends and teachers at Chicago who supported a floating currency system would say that we need a system of floating currencies, of floating exchange rates, like the one that we have had since the early 1970s, because there has been a superabundance of shocks in the markets for real estate and stocks and bonds and commodities. There's just a very large increase in the number of structural shocks. The competing interpretation is that these large changes in the prices of securities and the prices of real estate and the prices of currencies are a result of monetary shocks, a result of increases in the investor demand for foreign securities. So if I think of the Thai experience in the early 1990s, I would say Thailand, Malaysia, Indonesia, the Philippines, Hong Kong, South Korea, these countries experienced an increase in the foreign demand for their securities. So there was an increase in investment inflows into your country and into the neighboring countries. By 1997, some of the lenders were becoming apprehensive that the indebtedness of the borrowers in these countries and the indebtedness of the countries themselves was too large, and that the crisis occurred when the investors said, we are going to sharply reduce our demand for Thai securities, Malaysian securities, Hong Kong securities. So that's the tension that we're dealing with today. So this brings me back to an argument in the economics literature involving the benefits of a floating rate system as opposed to an alternative system in which central banks would intervene in the markets to limit the changes in the prices of currencies. So when I use the term proponents, these are the individuals who in the 1950s and the 1960s wrote articles in support of a system of floating exchange rates. And they said that if currencies were allowed to float, then the deviations between the market prices of currencies and the long-run average prices of currencies would be smaller than if currencies were pegged. They told us that if currencies were allowed to float, the changes in the prices of currencies would be gradual. They told us that if currencies were allowed to float, there would be fewer currency crises. They told us that if currencies were allowed to float, each country would have more insulation from shocks that would develop in neighboring countries in the rest of the world. And I want to suggest that the evidence for the last 40 years suggests that every one of their claims is just challenged by the data. The deviations between the market prices of currencies and the long-run average of prices of currencies are much larger. Let me just give you an example of the last 4 months. The US dollar price of the euro has declined from $1.38 equals 1 euro to, let's say, $1.105 or $1.10 equals 1 euro. That's a decline of 33%. The difference between the US inflation rate and the inflation rate in the euro countries is trivially small. It's not significantly different. And so what we've experienced in the last 4 months, 5 months, 6 months is a massive decline in the price of the euro relative to the price of the US dollar. That is having amazing impacts on the profitability of firms that produce in Europe relative to firms that produce in the United States. If you take an outstanding German firm, Daimler-Benz, produces Mercedes. Many of the Mercedes produced by Daimler-Benz are produced in Germany, but Daimler-Benz has factories in the United States that produce Mercedes. The change in the exchange rate has meant that the cost of producing a Mercedes in Germany relative to the cost of producing that same Mercedes in the United States has fallen by 30%. If I think of the profit rates in the German factory and the profit rates in the South Carolina factory, the change in the relationship between the profit rates has been several hundred%. This is not a way to run an international economic system. The proponents told us that change currencies would be gradual. You're probably too young. Most people in this room are too young to remember what happened in July 1997 when you had your banking crisis, but the price of the baht declined by 35%. The price of the Indonesia rupiah fell off. The Indonesia rupiah fell off a very sharp cliff. The price declined by 70%. In December of 1997, I was on my way to Seoul from the US, and as I looked at the currency board in the San Francisco airport, I saw the price of the South Korean won in terms of the US dollar. 12 hours later, I got off the plane in Incheon, and I looked at the currency board, and I said, there's been a massive mistake. This cannot be true. In the course of that week that I was in Seoul, the price of the South Korean won fell by 50%. This is not a way to run an international economic system. So the claims advanced by the proponents of floating exchange rates are seriously challenged by the data. These are very bright people. They missed something very important. Now, you very kindly mentioned my Icelandic experience, and let me review what had happened in April of 2006. I was visiting London, and I called a friend at the London Business School and said, please take me to lunch. And he said, I'll take you to lunch if you come to class and tell us what you're writing about. So I went to class, and there was another visitor in class that day. This was a young man who who had graduated from London Business School the year before in 2005. And he was a banker in Reykjavik. And he started talking about the Icelandic experience, and I had this very bizarre reaction. I could complete all of his sentences. I knew nothing about Iceland. He had a set of facts, and I had a model. And I put the two together, and as I left the classroom that day, I said, visit Iceland on the first possible occasion. And I went to Iceland in June of 2007 and visited with 10 or 12 economists at the central bank, in the commercial banks, at the University of Iceland, and concluded there was a massive bubble in the stock market and in the property market in Reykjavik. Many of the cranes, which had been in Bangkok in 1996 and 1997, were evident in Reykjavik. It's as if these cranes move from Tokyo to Bangkok, they move from Bangkok to Reykjavik, and they move from Reykjavik to Beijing and Shanghai. And then I got a call from one of the professors that I had visited with. That phone call was in December of 2007. He said, write a paper about the Icelandic experience. And so I had to take Iceland very seriously. And I wrote a paper and went to Reykjavik in early May, May 5th, 2008. And my first meeting was with the Prime Minister. And I had the delicate task of telling the Prime Minister, you're about to lose your job. You're about to be fired. There's going to be a massive implosion of asset values here. People will be hunting for the villain, and they will think that you, as the Prime Minister, must be responsible. And 4 months later, asset prices fell very sharply, and he lost his job soon thereafter. He was subject to a trial, I forgot what the charges were, and was not found guilty. Well, here's some Iceland data. So the first line is really the price of the Icelandic currency. So ISK is the symbol for the Icelandic krona. And you can see that the price of the Icelandic krona increases significantly. When I say the price of the krona increases, that means that fewer krona are required to buy a US dollar. So at the end of 2002, it took 80 krona to buy a dollar. And by the end of 2007, it took 60 krona to buy a US dollar. So the krona had increased in price by about 25%. Now the second line is Iceland's current account balance relative to its GDP. Now this is a ratio. And what you will notice is, one of the things that you'll notice is that in 2002, Iceland had a small current account surplus. In every subsequent year, it had a current account deficit. And its current account deficit sort of increased over time. And this is one of the largest increases in the country's current account deficit that I've seen for any country. If I review the Thai data, in 1997, the ratio of the Thai current account deficit to Thai's GDP was 6 or 7%. And that had increased steadily in those previous years. So what was happening? What explains this data? The Icelandic banks had been newly privatized beginning about 2000, the year 2000. And subsequently, they began to borrow in London and Zurich and Tokyo. And they brought the money back to to Iceland. and they use the foreign currencies to buy the Icelandic currency, and that caused the price of the Icelandic currency to increase. So that's the story about the first line. Now, I'll be technical for a moment. One of the basic propositions in international finance is that if a country's currency is floating, the balance on its capital account and the balance on its current account must be equal, but with opposite signs. Let me just repeat that. If a country's currency is floating, the balance on the country's capital account, that is trade in securities, and the balance on its current account, think of trade in goods or trade in goods and services, those two balances must be equal in absolute value, but they must have different signs. So here we see the negative Iceland's current account deficit, but that reflected that it had a capital account surplus that was as large. So the story is the Icelandic bankers went abroad, they borrowed money in London and Zurich, they brought the money back to Iceland. So the inflow of money into Iceland was a capital account surplus for Iceland, and adjustments were necessary in the Icelandic economy so it would have a counterpart increase in its current account deficit. And I will speak to the mechanism. Where does this increase in the current account deficit come from? I'll speak to that mechanism a little later. Now, when I look at this data, one of the questions I ask is, what's the date of no return? And let me explain the concept of the date of no return. I fly small airplanes, and I have a Walter Mitty moment. Walter Mitty was this very ordinary man who had dreams of greatness. One of my dreams of greatness was that in April 1927, that was a year or two before I was born, but nevertheless it was a dream of greatness, that I was at Roosevelt Field, Garden City, Long Island. The coach of Charlie Lindbergh, as he was about to take off to fly to Le Bourget Airport in Paris, and I was yelling to Charlie, when you come to the 19th meridian, remember the meridians that divide the globe on a north-south basis? Charlie, when you come to the 19th meridian, you can't turn back. The winds will be against you, and you won't have enough fuel. That's the concept of the point of no return. So I've modified that to the date of no return. So when I look at this Iceland data, the question I ask is, what's the date after which an Iceland crisis was inevitable? So you will remember that earlier I said these crises occur when the lenders tell the borrowers no more credit, or we're going to reduce the rate of growth of credit. If the lenders had told the Icelandic banks, let's say in March of 2005, no more money, the price of the Icelandic krona would have fallen from 62 to 100. The price of the krona would have fallen by 40 or 50% overnight. That meant that the indebtedness of Icelandic borrowers in foreign currencies would have increased by the same amount. These Icelandic borrowers, some of these borrowers would have incurred massive losses because of the increase in the krona equivalent of their debts denominated in foreign currencies, and they would have defaulted. They would have not been able to repay their loans to the Icelandic banks, and the Icelandic banks would not have been able to repay their loans to the foreign banks. Now this concept leads me to think, when I return to Chicago, I should look at the Thai data once again. So the data in the crisis in Thailand occurred in July 1997. I was here in March 1997, and as I indicated earlier, I said a crisis is on its way. But if I look at the Thai data again, will I come to the conclusion that by, let's say, the end of 1995, a Thai crisis was inevitable? Because the external indebtedness of Thailand had increased so rapidly, and the price of the Thai baht had increased so much that when the foreign money stopped coming in, the price of the baht would have fallen, and Icelandic borrowers with debts denominated in a foreign currency would have faced large losses. So let me come now to what I'd call this some stylized facts. When I say stylized facts, these are observations based on looking at the experience of 40, 50 countries. Every banking crisis follows an economic boom. Each of these economic booms follows an increase in investment inflows. The one exception that we're going to see is that of China. These investment inflows lead to a surge in domestic credit. Let me just amplify that point. The Icelandic banks borrowed abroad, and they brought the money back to Iceland, and they increased their loans to Icelandic borrowers. If I review the U.S. experience after 2003, there was a surge in the foreign demand for U.S. dollar securities. And many of these foreigners bought the bonds issued by Fannie Mae and Freddie Mac, the two government-sponsored mortgage lenders. And because these mortgage lenders were able to borrow much more readily, they were able to increase their loans to finance the purchases of mortgages. So these investment inflows lead automatically to an increase in the supply of domestic credit. And they lead to an increase in the prices of domestic securities. In the Icelandic case, in a period of 4 years, the price of Icelandic stocks increased by a factor of 9. The prices of these currencies have increased, and as I've indicated earlier, the increase in the price of currencies was too rapid to be sustained. Now let me come to the model of adjustment when currencies are floating. And this is my model of adjustment. And I would say this process is biologic in its regularity. There's a shock. The shock leads to an increase in investment inflows, and then adjustments are necessary in each country in response to the increase in investment inflows. And as I indicated earlier, the country must experience an increase in its current account deficit that corresponds with the increase in its capital account surplus. The prices of securities increase, imports increase in response to the country's consumption boom. And the boom itself induces more inflows, and then the lenders become more cautious. Now thus far, I've essentially been making what I would call descriptive statements about the stylized facts. And now I want to make 4 analytic statements. And let me review each of these, and then we'll go over each of the 4 in depth. So we have a shock. A shock leads individuals, investors, to change their perceptions about the attractiveness of cross-border investment inflows. So a shock leads to the increase in investment inflows to the country. We might ask the question, what was the shock that led to the increase in investment inflows to Thailand in the early 1990s. And that shock actually occurred in Tokyo. And the collapse of real estate prices in Tokyo was associated with an increase in the price of the Japanese yen. Japanese firms felt that they were losing export market if they sourced for the foreign markets from Japan because of the increase in the price of the yen. And so they began to increase their direct investments in Thailand, Malaysia, Indonesia, the Philippines. So that was the shock. And this shock leads to a prolonged increase in cross-border investment inflows. The second proposition I'm going to discuss is that the increase in the price of securities is a result of the increase in investment inflows. Now, the third analytic statement is that the increase of indebtedness is too rapid to be sustained. And I'm going to introduce you to the concept of a primary deficit. And in a way, this gets back to Michael Lewis's comment on Tim Geithner's view that the U.S. banking crisis of 2008 was an act of God. It wasn't an act of God. The foreign investment flows into the United States have been too rapid to be sustained. And it was clear that when the foreign investment inflows slowed, that the price of the dollar would decline and that the price of U.S. securities, including real estate, would decline. And my fourth proposition is that these crises are not independent events. So I've identified 4 waves of crises. One interpretation is the booms that preceded each of these waves is independent of the previous boom and crisis. The competing interpretation is there's a systematic relationship between one banking crisis and the next banking crisis. So let me come to what I would call the first of these analytic statements, and this is involves the adjustment in the global money market. And what I want to show is that a shock leads to a prolonged cross-border investment inflows. Here's the issue. Some of you have studied the modern theory of finance. The modern theory of finance says that if there is a shock and the prices of securities change, investors rush to buy the securities, and now the cliche, so that no money is left on the table. In that case, the adjustment is immediate rather than prolonged. I want to suggest that in the international money market, the adjustment is not immediate, it is prolonged. And let me give you the following example. In the 1970s, the United States experienced a surge in the inflation rate, and there was a run on the US dollar. In August, to the end of August 1999, President Carter appointed Paul Volcker, who was then president of the Federal Reserve Bank of New York, to become chairman of the Federal Reserve Board. In late October 1979, Volcker adopted a very tough anti-inflation policy. U.S. interest rates rose, increased very sharply. Real interest rates had been negative before the shock. They became positive and very high immediately after the shock. Now, if one is a fan of efficient markets, one would have said the adjustment to the shock would have been immediately, and the price of the dollar would have risen instantaneously, and thereafter, the changes in the price of the dollar would be a random event. I have a different interpretation, and that is that yes, the price of the dollar increased, but the demand for US dollar securities was prolonged rather than instantaneous, and so the foreign demand for US dollar securities continued to increase for the next 5 years, and the price of the US dollar continued to increase for the next 5 years. So that meant that the United States had a very prolonged capital inflow, much as Thailand experienced a prolonged capital inflow from 1992 through 1996. The second analytic statement is how the domestic economy adjusts. So this takes us back to our basic international finance course. And what we're trying to understand is why each of these countries that experience investment inflows also experiences an economic boom. And essentially what happens is that the investment inflows lead to an increase in the price of securities, that the increase in the price of securities leads to an increase in household wealth, and that the increase in household wealth leads to a surge in consumption spending. And this increase in household wealth and the increase in consumption spending is necessary to ensure that the increase in the country's current account deficit corresponds to the increase in its capital account surplus. This is not an accident. The countries have consumption booms. These consumption booms are important. Your boom in 1990, your stock prices doubled in 1993. The boom in your economy in the next 3 years resulted from a continuation of the investment inflows into Thailand. And so the current account deficit increased because of the surge in household wealth. And this takes us now to the third analytic propositions. Let me explain the meaning of the term primary deficits. This is a term I borrowed from fiscal policy literature. The fiscal policy literature says that if the expenditures of a government, exclusive, that means not including, that its interest payments are larger than its revenues, the country has a primary deficit. If a country has a primary deficit, deficits have to be financed, the amount of its borrowing will be greater than the increase in its indebtedness. And that means that the country is on a non-sustainable trajectory. So a primary deficit means, for a country means the rate of increase of its international indebtedness is too large to be sustained. The primary deficit for a household or for a government means the rate of increase of its indebtedness is too large to be sustained. A current example from the last several years, Greece. The deficit of the Greek government was so large that it had to, that the increase of its, that its borrowing, the increase of its indebtedness was larger, was extremely large. Greece was on a non-sustainable trajectory. Now what I've done in this little matrix, this is a scorecard on sort of 40 countries. So I look at the international payments position of each of these countries, and I ask myself the following question: did the country have a primary deficit or a secondary deficit the year before its crisis, 2 years before its crisis, 3 years before its crisis? And then in terms of the rows, I ask the same question. Did the borrowers within this country have a primary deficit, that's the top row, or did they have a secondary deficit, that's the bottom row? Secondary deficits are sustainable, primary deficits are not. And my finding is, this is a statement about the data, is that every one of these, not everyone, nearly every one of these countries had a primary deficit in its international payments and the borrowers within these countries had a primary deficit in their domestic payments in the several years before the crisis. Since we know primary deficits are not sustainable, we know that a crisis was predictable. We can say this a crisis is predictable without sort of predicting when the crisis will occur. And that meant the authorities. That meant that the International Monetary Fund. That meant that each of these governments should have foreseen that the path of the growth of indebtedness was not sustained. Now here's the last analytic statement I want to deal with, and that's what I would call sequential overshooting. So what I'm trying to get at here is whether these banking crises are independent events or whether they're related to a previous event. So I mentioned earlier that there was a run on the US dollar in the 1970s, and that was due to several factors. One was that in the 1960s, the US government had said the dollar is as good as gold. In August 1971, the US government said the dollar is no longer as good as gold. And then we had a horrendous monetary policy, a very feckless monetary policy in the 1970s. That led to a run on the dollar. I've mentioned the Volcker shock. That led to a run back into the dollar. In the by mid-1980s, let's say in the summer of 1985, the price of the dollar was exceedingly high. The US had a primary deficit in its international payments. And the investment flows to the United States slowed. And that meant the investment outflow from Japan slowed. And that meant that the Japanese economy had to adjust to a decline in its capital account deficit. And my interpretation is that the increase in the prices of real estate and stocks in Japan in the second half of the 1980s are a result of the decline in its capital account deficit. Earlier I mentioned that when Japan had its banking crisis, the investment outflows to South Asia increased. So I think there is a systematic relationship. So let us now, you've been very patient. Earlier I started with what are the benefits of the cost of floating exchange rates. The benefits are that changes in the prices of currencies supposedly are depoliticized. But what are the costs? We've had much greater deviations between the market prices of currencies and the real price. We have massive swings in cross-border profit comparisons. Countries import boom and bust cycles, as Thailand did in the 1990s. We've had greater scope for beggar thy neighbor policies. You will remember that one of the arguments for establishing the International Monetary Fund was to use an international treaty so that countries would not reduce the prices of their currencies in order to gain an unfair export advantage. Now many countries in this part of the world managing the price of their currencies in order to grow their exports of manufacturers. Well, let me conclude. We have an international monetary system which is dysfunctional. That cross-border investment flows surge that lead to booms in countries, but the increase in the indebtedness is too large to be sustained, and when the lenders become more cautious, then the inflows slow and the countries experience a crisis. So let me come to the last overhead and then we'll take your questions. Perhaps I need help on that one. Perfect. So earlier I started with 5 questions, and here are the 5 answers. What is the cause of the turbulence. It's the variability of cross-border investment flows. The real estate booms in each country follow increase of investment inflows. The banking crises occur when the investment inflows slow, and the correction of imbalances in one country leads to a crisis in another country. We have a very flawed international monetary constitution. You've been very patient. I'd love to hear your questions, sources of disagreement, or comments on the Thai experience. Thank you very much.